What's up, YouTube? This is your personal finance professor back with you again, and today we're going to be talking about standard versus itemized deduction. What is it? Why should you care about it? Here we go. Okay, on one hand, we have the standard deduction. The standard deduction, on the other hand, we have itemized. Standard, itemized. Standard, itemized. Okay, standard deduction. This deduction in 2019 is $12,200 versus the itemized, okay? Now $12,200 is for a single, okay? That's a single filing. It's actually $24,200 for married couples and around $18,000 for head of household. So now, what is a standard deduction? Essentially, this is money that you deduct from your earned income on federal tax reporting. So if you made $100,000 a year in gross taxable income, you would take $12,200 off that if you were a single reporting tax filer, okay? This is, now you're saying, well, what does this have to do with the 401k? If you contribute to a pre-tax 401k, you would take any dollars additionally. So say you contributed $10,000 to a 401k in 1 year, that would bring you down to 90, and then this would bring you down to 77,800. So you just keep subtracting, so it keeps bringing your income down. But you don't have to contribute anything to obtain this. This is free from the government. It's called standard deduction. Okay? What is an itemized deduction? Essentially how this works is you can either take the standard deduction or the itemized deduction, but not both. So you, as a conscientious tax filer, would want to take whichever one is more. So your base starting is $12,200. Now, what makes up itemized deductions? Okay, 4 main things. 1, property taxes. So if you own a home, any property taxes, also called local taxes, depending on where you're at. So property taxes are deductible under the itemized. Your state income taxes. So if you're in a state that has income tax, state income tax is deductible from your federal income tax, okay? So also the third thing is mortgage interest. So if you have a mortgage and you're paying interest on that, and especially in the early years, you're paying a lot more interest, and it goes down year by year towards the end. But in your early years, you're paying a lot of interest on that mortgage. All that interest is able to be written off as an itemized deduction. And then lastly, charitable giving. So any money you give to any sort of charitable organization, place of worship, anything that it has, you know, that tax deductible slogan, or that tax deductible nomenclature within their donation platform. So those 4 things make up the itemized. So basically, if the sum of those 4 things for you is more as a single filer than $12,200, or more than as a married filer is $24,200, then it makes sense to itemize and claim these deductions. Okay, again, itemize property taxes, mortgage interest, state income, and then state income tax, and then charitable donations. Okay, so charitable donations, by the way, doesn't just have to be money. This includes giving clothes to your local Salvation Army or Goodwill. Okay, this could be donating a car, to a tax-deductible charity. So it could be anything like that, okay? So that's why, it's really important, when you think about this. If you, say as a single, you have a fair salary and you're getting taxed a little bit in your state because it's a relatively high tax state. Say you pay $5,000 in state income tax, okay? So that's $5,000. Say you just recently bought a nice condo for yourself, and say you're paying roughly another $5,000 a year in mortgage interest because you just bought a condo this year, okay, for $5,000 per year. And then also say that property tax on that condo is $250 a year, okay. That adds up right there to $12.50. So that's already more than the standard. So already you want to itemize, because each dollar that you itemize brings your taxable federal income lower, and you don't have to pay tax on that. So essentially, what this looks like is, if, say, you make $100,000 a year as a single, which I believe puts you in the marginal 24% tax bracket, okay? That means each additional dollar you earn gets taxed at 24% federal rate. So each dollar of charitable donations that you donate, because you know you're going to itemize, this is more than this. Each dollar that you're going to itemize essentially is worth 24%, okay? 24% of your of the value being donated, okay? So if you were to donate $100 worth of clothes that you haven't worn all year, that's going to save you $24. Why is that? Just to run through the math again. So now, say if you donate $100 worth of clothes to your local Salvation Army, now you're looking at $12,600. Now you take your salary of $100,000 per year minus $12,600 versus you would be taking $12,500. Okay, so there's $100 now that you can write off of your income, and you're getting taxed at 24% rate. Okay, so that's where the $24 of saving comes from. Okay, so that's how you can actually save money on your old clothes, your old shoes, stuff, your gently used toys, anything that you donate to Salvation Army. Instead of just donating it and throwing it at them, record it. Okay, you would be shocked how much they have a record value online. You can look up for Salvation Army or Goodwill, and you would be shocked to see how much they value youth clothing as, and you would be shocked to find how fast 20 articles of used clothing add up, and you know, before you know it, you're donating $300-400 worth of old clothes that you never wore and didn't really think they were worth that much. Write that off your taxes. That's $100+ of straight money that's coming back to you in savings on federal tax return. Okay, not to mention, of course, if you're giving lots of money to a place of worship or a charity that you're interested in. I mean, if you're giving, say you're a big tither or a big donator, you get $10,000 a year. Okay, 24% of that's coming back to you. Okay, $2,400 of that is going to come back to you. Okay, through federal tax savings. So this just goes to show that there can be two-sided benefits. Of course you want to give out the goodness of your heart because you care about fellow humanity. That should be your number one priority. But that said, you need to look at the numbers to make sure that through giving, you could potentially be getting some other benefits from that as well. And can I suggest possibly funneling that money that you're saving in federal taxes back into that charity, so now you're able to give to that charity with even a greater impact than you would otherwise be able to. Okay, so guys, this is standard versus itemized deduction, charity donations. Thanks for watching. Please like, subscribe. Any questions in the comments. Until next time, this is your personal finance professor signing off for now.